Paul's first idea is Bank of America.
So Bank of America, as you know, Andrew, is one of the largest banks in the United States. It has about 10% of all the deposits in the country. I think the bank continues to reduce costs through kind of headcount and technology, and the company continues to have a really great capital base. Their Tier 1 capital, so at about 12%. It trades at 10 times. Trades about 10 times earnings, 1 times book. So I don't think it's an expensive stock at these levels. It has a dividend yield of 2.9%. So we think the intrinsic value is somewhere above 50. I think what uniquely about this company is that they can, they continue to buy back their shares. Their payout ratio is relatively low, so I think you have a good chance of increasing dividends. I think the stress test came out, so there may be a little less ability for them to do it in this environment, sort of increase dividends and buy back shares as much. But I think they're still able to do a lot of that stuff. I will say that you probably have to see more from an organic growth perspective because they can't buy anything because it's such a large business, and they have. So that's really, but they have some really strong businesses in Merrill Lynch and investment banking. So I think it's a great bank to own at these levels.
Okay, your next idea, First Service, the big provider of maintenance services for real estate.
Yeah, so the company focuses on residential property management and services. So they own things like California Closets. I think there's lots of room for it to grow. The market share in the United States although they're kind of one of the largest players in the United States, it's still a very fragmented business, so they continue to make acquisitions. And they can grow organically. I think one of the great things about this business is that it's a very capital-light business. There's not a lot of capital expenditure, and I think that they have a real opportunity in this environment specifically to do good acquisitions. They've been very good at doing acquisitions over the years, and I think they can continue to grow there and really build a much bigger business over the next several years.
And finally, EssilorLuxottica, the big player in eyewear.
Right, so EssilorLuxottica is a global leader in design, manufacturing, distribution of optical lenses, frames, and sunglasses. So they own sunglasses, they own LensCrafters, that's one of them, some of the brands that they own. They own Oakley. So Essilor is a market leader across the kind of the entire value chain of eyewear. And the eyewear business really offers, I think, what is attractive long-term resilient growth. It's demographically, it's a great play as well. And I think that what's happened over the last 2 years is that screen usage has gone up exponentially, and so it's caused a lot of eye problems. So I think that eyewear, especially on the children's side, which is very funny, the growth in eyewear among children has grown a lot. They made an acquisition called Grand Vision. I think it's a transformational acquisition for Essilor. So I think they're going to be also a winner on the digital transformation of eyewear. So the stock trades has a dividend yield of about 2.3%. Has really strong balance sheet, and they're going to be seeing accelerating free cash flow growth. And I think the other thing is because they made the acquisition of Grand Vision, there's really nothing else they can buy. So the company is really going to reconcentrate on integrating that acquisition, but also growing the business organically. And I think there's a great opportunity there.
It's interesting. I'm not sure if you saw this story, but just a few days ago, Leonardo Del Vecchio, the Italian entrepreneur who built EssilorLuxottica, and he started off with one shop. He grew up in a Milan orphanage, and he started off with a shop in a town in the Alps north of Venice.
Yeah, so it's a pretty incredible story. So he started Luxottica. Essilor. So it's a combination of a French and an Italian company, which always doesn't seem like it's going to work, but it has worked out. Essilor was the kind of lens business. Luxottica was the frame business and the sunglass business. And so, yeah, absolutely. I think he's pretty incredible story, pretty incredible gentleman. And I think that, that's why I think the opportunity is, because they've kind of consolidated the business, and there's really, I would say, almost an oligopoly. Certainly on the lens side, they have an oligopoly. So I think there's great growth and probably some good pricing power over the next several years.
Yeah, their brand.